If you've ever checked your balance, felt that familiar spike of stress, and wondered how the numbers keep slipping away even when you're doing everything right, this episode is for you. The truth is simple and not personal. Banks are not designed to optimize your life. They're designed to optimize theirs. That doesn't make them villains, it makes them businesses with incentives. If you don't understand those incentives, your money will quietly pay for other people's buildings, bonuses, and banners. Today, we'll strip the mystery away. You'll see how ordinary banking practices drain your cash, your attention, and your future, and how to flip the script so you use banks as pipes, not as puppeteers. No rage, no conspiracy, just the mechanics and the moves that keep you out of the traps. Start with the honest map of how banks profit. At a high level, they sell money. They pay you a small rate on deposits, they charge a larger rate on loans, and they collect a spread between the two. That spread is called net interest margin, and it's not evil, it's the business. Around that core live the fees: account maintenance charges, overdraft and non-sufficient funds, or NSF fees, out-of-network ATM fees, wire and transfer fees, foreign transaction fees, paper statement fees, and a catalog of gotcha charges that exist because people are human and tired. Layer in cross-selling, credit cards, personal loans, relationship products you didn't ask for, and you have the modern retail banking experience. Many small levers that turn your calendar into their revenue. If you don't install counter levers, your money pays rent in their system without buying you freedom in yours. This is why smart money management begins by separating function from feeling. A glossy app and a friendly branch don't change the incentives. Banks love three things: inertia, confusion, and timing asymmetry. Inertia is you staying put even when a better option exists. Confusion is you not understanding how a teaser rate, a fee schedule, or a relationship tier actually works. Timing asymmetry is them charging you immediately and refunding you slowly, releasing your deposits on their schedule while charging interest on yours. The antidote isn't to become a hater, it's to become a designer. You'll redesign your money's flow so the bank can't capitalize on your bad Wednesdays. Let's start with the silent killer: overdraft. Overdrafts are a feature banks market as protection but monetize as punishment. An overdraft fee doesn't represent a day of bank pain. It represents a moment of your inattention. Maybe a subscription hit early, maybe a deposit got held, maybe a card reader double charged. Whatever the trigger, overdraft is the price of timing, not morality. The defense is not white-knuckling every swipe, it's structure. Route income into a quiet staging account with no card attached. From staging, 4 automatic moves run your month. On payday, a transfer pays your future into savings, and if you invest, a boring, diversified portfolio. In week 1, a bills-only account drafts your fixed obligations and minimum debt payments. The day after payday, tiny drips fill labeled sinking funds for predictable irregulars: tires and service, copays, gifts, travel, school, the winter energy spike. Every Friday, a weekly card refills to carry groceries and ordinary life. When your card only ever touches the weekly money and your bills draft from a protected account, overdrafts become exceptional rather than inevitable. You're removing timing risk, the thing banks quietly tax, from your worst hours. Then there's the deposit hold, the bank's right to put your money in timeout after you deposit a check or a large transfer. Holds exist to prevent fraud and bad funds, but they also create that timing asymmetry. They can collect interest on your deposit today while telling you funds available next week. The counter is twofold. Avoid being dependent on pending deposits by building a sleep fund. 1 week of essential expenses, then 1 month, then toward 3 to 6 months as your responsibilities grow, and route deposits to accounts with real-time or faster availability when possible. If you work with clients, build deposits into your contracts and invoice cadence so you're never waiting broke for processing. You are not helpless in the face of holds. You can design your runway. Maintenance and minimum balance fees are the soft tax of inertia. Banks know many customers won't move for 5 or 10 euros a month, but 10 a month is 120 euros a year, and a quiet annual leak like that compounds into real numbers over a decade. The defense is a quarterly rebuy ritual. Read your account's fee schedules and ask out loud, would I buy this account again today at this price for these features? If the answer isn't clean, switch. Online banks and credit unions often pay substantially better yields on savings and charge fewer fees because they don't carry the cost of a large branch network. If you stay, call and ask for a fee waiver. Half the time, politeness, tenure, or a direct deposit is enough to make the leak disappear. Loyalty is only rational if it's rewarded. Foreign transaction fees are a 3% handshake tax on your way through the airport. If you travel or buy from overseas merchants, use a card that doesn't add that toll. Out-of-network ATM fees are similar, small and maddening. When you build a weekly cash routine, one planned withdrawal or none, you kill the emergency cash run that carries a surprise surcharge. The point isn't to memorize every line of a fee table, it's to design your week so the table isn't your landlord. The next quiet drain is your savings rate, specifically the insultingly low yield on idle cash at big, comfortable banks. When inflation quietly eats your purchasing power and your bank pays a number that looks like a rounding error, you're lending them money for almost nothing while they lend it out for a lot. The fix is not exotic. It's moving your sleep fund and any mid-term savings to a reputable high-yield savings account or cash equivalent vehicle appropriate for your risk and time horizon. Your spending bank doesn't need to be your saving bank. Think of it like this: one bank to spend, one bank to store. You want checking that's convenient and savings that pays, even if it lives 2 taps further away so you can't raid it during a bad mood. Separation is a feature, not a bug. Credit cards deserve their own chapter because they are the most aggressively marketed product in retail banking. Cards aren't free points with no downside. They're a loan that resets monthly with a rate that could buy a used car. Rewards are a rebate on profitable behavior for the bank. If you carry a balance, your points are expensive candy. If you pay in full every month and set everything to autopay, fine, you're riding the system. If you don't, you're working for it. The fix is two-pronged. First, stop using the card as a fake emergency fund. Your real fund will live in savings and show up on a calendar. Second, if you're in the habit of carrying balances, run your weekly life on debit with a flat Friday refill so you can't exceed your planned fuel. Keep one card for travel and online purchases on autopay in full with alerts that tell you when a large charge hits. You're not swearing off modern payments, you're killing interest income for them by killing confusion for you. Now let's talk about the cross-sell, relationship banking. Banks will bundle a savings account with a low teaser rate, a checking account with a fee you can waive if you keep a high balance, a credit card with special points, and a personal loan that solves a problem you don't have. The sales script will promise premier service if you scatter your life across their products. The result is you become sticky, and sticky customers pay more by doing less. The defense is single-purpose simplicity. Checking handles inflows and bill drafts. A weekly card handles groceries and ordinary life. Savings holds the sleep fund and the next few named goals. Investments live with a reputable brokerage. Credit is backup, not behavior. Any product that requires you to jump through hoops to avoid being taxed is a product you should consider replacing.
Another way banks win is by selling uncertainty back to you. Dynamic currency conversion offers to charge you in your home currency abroad, letting the merchant or the network set a friendly-looking rate. It is almost always worse than letting the network perform the conversion. Teaser rates promise a high yield or low interest for a few months, then drop you into a pit you won't notice until your statement groans. Promotional balance transfer offers save you from one card's APR, while they set a trap of deferred interest if you don't pay the promotional balance by a date that will arrive faster than your brain expects. Again, the defense is design, not willpower. You accept that banks will always invent complexity. You answer with rules that ignore it.
no dynamic currency conversion, no teaser you couldn't afford at the real rate, no transfers without a calendar plan that pays them off 3 weeks before the deadline, no long financing for things that will be over before the bill arrives. There's also the quiet behavioral engineering of apps. Notifications are designed to trigger, not to calm. You have points expiring is a nudge to spend. Your pre-approved is an invitation to borrow for lifestyle. You could increase your credit limit is a reminder that you can make more promises on future Tuesdays. The fix is to edit your alerts to the few that matter. Deposit received, bills account below a threshold, weekly card refilled, large transaction posted, and a low balance nudge for the weekly card on Thursday so Friday doesn't surprise you. Everything else is marketing telemetry. Turn it off and your brain gets to be a brain again instead of a dopamine laboratory. Banks also love subscription creep because it creates predictable fee revenue elsewhere in the economy, which cycles back through your account in overdrafts and interest. The solution is your quarterly rebuy ritual. Read each recurring charge aloud. Would I buy this again today at this price? If the answer isn't clean, cancel or pause. If you need it later, it will still exist. Redirect the recovered money into your sleep fund for a quarter. Your bank would prefer you keep habits that keep accounts busy. You will prefer to keep habits that keep accounts calm. Let's pivot from problems to design. Your household bank system will obey dates, not moods, and will make the bank's favorite revenue streams, fees, timing, confusion, hard to access. Income lands in a staging account. On payday, a small transfer pays the future, a drip into savings, and if you invest, into a low-cost diversified portfolio. In week 1, a bills-only account drafts rent or mortgage, utilities, phone, insurance, transport passes, childcare, and minimum debt payments, with due dates moved there intentionally. The day after payday, tiny drips fill labeled sinking funds that catch predictable irregulars. Every Friday, a weekly card refills to carry groceries and ordinary life. You, tired you, touch only the weekly card. Your bank app becomes a status board, not a casino. The game flips. You use the bank for pipes. The bank doesn't use you for content. You'll also choose your institutions by role. Use a convenient checking bank for inflows and bills. Use a high-yield savings provider for the sleep fund and near-term goals. Use a reputable, low-fee brokerage for investments. Use a fee-free, travel-friendly card for flights and international purchases, on autopay in full. The one bank to rule them all fantasy is an artifact from a time when walking into one building mattered. In a digital world, specialization saves you more than convenience does, especially when that convenience manufactures fees. What about safety? Deposit insurance exists to stop ordinary bank customers from living in fear. Respect the limits. Keep your emergency fund within insured thresholds per institution and ownership category. Don't treat the promise of safety as a reason to ignore diversification. If you hold more cash than the insured limit at a single institution for a long time, you are choosing concentration risk without being paid for it. Spread large amounts across insured buckets if you actually have them. Most people don't. Most people have the opposite problem, not enough buffer to take advantage of any bank's safety net. That's why the Sleep Fund is your first construction project. Banks also make money from your attention deficit. They profit when you forget to unenroll from paper statements that carry fees, when you miss a safe-to-spend threshold and trigger a transfer from a linked account that costs a $5, when you pay for a wire that could have been a free transfer had you waited a day. You defeat this with a 5-minute Monday check. Did the transfers run? Is the bills account funded? Are any irregulars arriving in the next 2 weeks? You move your phone charger out of the bedroom, so the first minutes of your day go to water, daylight at a window, and that tiny check. You leave your bank alone the rest of the day. You're not supposed to be the accountant and the hero. You're supposed to be a human who set a system that works while you're living. Banks also tilt you towards financing lifestyle because payments are predictable revenue for them, and unpredictable constraints for you. A finance plan with a cheerful 0% for 12 months on a gadget you'll forget, a car loan stretched to 8 years to make a luxury feel normal, a store card that attaches a little discount to a large leash. These are not crimes, they're business. Your counter business is to decide in advance what you'll finance and what you won't. If it lasts longer than the loan term and it increases capacity, stability, or safety at a cost you can endure on a bad Wednesday, maybe. If it will be over before the bill arrives, no. Put that policy in writing so your future excited self has to pass through a gate your calm self made. Now, let's get practical with rooms where people live. A 26-year-old nurse keeps accidentally overdrafting. She puts income on rails. Paydays trigger a small savings transfer and a tiny investment. Week 1 drafts pay rent, utilities, phone, and a card minimum. The day after payday, drips fill tires and service, co-pays, gifts, travel, and December. Every Friday, a weekly card refills to carry groceries and ordinary life. Overdrafts vanish because the card cannot reach the bills account. She ignores her bank app most days. Her nervous system notices first. Her statements catch up in a month. A 31-year-old parent thinks banks hate him because surprises keep showing up. He lists every irregular from the last year, names a sink for each, and sets drips. He moves due dates so nearly everything drafts in week 1. He builds a trunk kit: water, snack, charger, small towel, bandage, a spare 20. He switches his savings to a high-yield account 2 taps further away. He cancels 3 subscriptions during a rebuy ritual and redirects their totals to the sleep fund. He still has toddler chaos. He no longer has bank chaos. A 39-year-old freelancer lives in feast and famine and resents banks for holding deposits. She becomes her own payroll. All revenue lands in staging. She skims taxes, skims a small savings transfer, fills the bills account for the next cycle, and pays her household the same safe Friday number from a buffer. She formalizes deposits with clients and adds work pauses when payment pauses to her contracts. Deposit holds become an inconvenience, not a crisis. The bank stops feeling like a warden and starts feeling like plumbing. If you ever need to get your bank on your side, you advocate calmly with data. If a fee appears, ask for a one-time courtesy refund, then ask how to prevent it next time. If a hold is longer than policy, ask what evidence would shorten it. If a card number is compromised, request expedited replacement and ask for reversal of any resulting fees. Document the call, time, and name. Polite paperwork gets more done than rage. Banks are structured rooms. Speak their language when you want something from them. Use your own system when you want freedom from them. There's one last reason banks feel like they make you broke. They make spending frictionless and saving invisible. Taps and swipes are Vegas smooth. Transfers to savings are delayed and hidden behind extra screens. Reverse this. Make saving the first action on payday, automatic and unglamorous. Make spending slightly inconvenient by using a weekly card with a fixed refill and keeping savings 2 taps further away. Human brains respond to friction. Put it where it helps, remove it where it hurts. Because this is 2026, a quick word on newish payment toys. Buy now, pay later options promise painless timing. In practice, they multiply your due dates and crowd your calendar. A free installment plan for groceries is a red flag that you're financing yesterday with tomorrow. If you must use one, isolate it to a single, fixed purchase with a short term and pay it from your bills account in week 1. Don't let a stream of mini payments colonize the month that your rent and insurance already need. Your bank loves the volume, your brain doesn't. You might ask, isn't this just being organized? Yes, and that's why it works. Banks don't need you to be reckless to get paid. They need you to be tired and undeliberate. When you put money on rails, staging to bills to sinks to weekly, you deny them the chance to tax your timing. When you move your sleep fund to a high-yield home, you deny your inertia. When you edit your alerts, you deny them your attention. When you write a small policy about what you'll finance and why, you deny them your confusion. None of this requires a fight. It requires design. If you share finances, replace telepathy with a 10-minute weekly check-in. 4 questions.
Did the transfers run? Is the bills account funded? Is the weekly card on track? And are any irregulars arriving in the next 2 weeks? Add one small joy you'll fund on purpose. Keep a threshold for big purchases that requires a conversation, and keep small, no-questions allowances for adults to have toys without court. Calm homes save